Another one bites the dust. VSH, Vishay Intertechnology Inc. Another Russell 2000, guys. Economic cycle, business cycle, getting to the end. 4 months, 6 months, 8 months. Can't put your head in the sand anymore. We're really closing there. This week, I think we got the inverted yield. So it's just a question of time. The U.S. always the last market to hold up strong. You had all bull markets breaking down this summer. Now they're pulling back within their stage 4 declines on the monthly chart. Not all of them. You got some ones that are doing as well as the U.S. stocks, U.S. markets. So I'm still looking. I'm getting ahead of the curve. I'm looking to prepare myself to have the best, the weakest of the week. And the weakest U.S. market for me is the Russell. It's the one that's not able to go back or hasn't been able to go back above its 12-month moving average. That's a higher trends weight that it bears on all the smaller time frames within it. Weekly, daily, 4 hour, 1 hour. If the monthly trend decides to steamroll you, your stage 2 breakout on the weekly is going to get crushed. Your stage 2 breakout on the daily is going to get crushed. You're not putting chances in your favor. Just like here, when you see those red candles, always when going back up. So if ever you thought you were going to play stage 4 here on the daily, maybe this kind of could have looked like a small stage 4. When that stage 2 picks up, just wipes you up. So you don't fight. This would have never, don't fight this. After nice bottoming, after 12-month average, trying to turn up, going upwards, don't fight it. And don't fight it when it starts to go down. 12-month average still going up. So this is a stage 3 on the monthly chart. But look at that pattern, that monthly chart defined top. That looks pretty much like a head and shoulders. That's a huge pattern. Gotta respect that on the higher time frame. Don't mess with it. All right. So now we're just gonna make sure that the trend is gonna be in our favor. Right now we're below the 12-month moving average. We're gonna wait. We're gonna wait for the end of the month. We're gonna wait to see where we close on the smaller time frame. This is probably gonna start looking already like a stage 3, maybe stage 4 already on the smart time frames. And as time moves on, as the longer we stay below that 12-month moving average, it's going to start declining. We're going to start hitting it, then going down. And you know the game, support turns resistance, and then you get good risk reward entries right here on those on that pullback to that huge breakdown line. And look at that target. Look at that insane target. That's my greedy target. So that greedy target brings me all the way down close to 10. All the way here to those 2015 lows. So that's pretty sweet. I like the symmetry of it. It might hit some congestion at the breakout right here. So off this base, when you break out, that's resistance is now support. We could hit some resistance here, some support here, but you know the game. You bounce off, and then after that, you get another entry right here if we get all the way down to there. So look at this massive stop. It's just glaring that it's there. And as long as you're below 12-month moving average, you shouldn't be long. So the weakest of the week, let's zoom in with no further ado on my Stan Weinstein Russell 2000 template. I'm comparing it to the Russell. Ooh, red. So why short the Russell when you could short its weakest components? Underperforming the Russell, check. The Russell is underperforming its peers, check. Back in December, the Russell is the one that dropped 27%, while the other indexes barely did 20. Stage 2 uptrend, beautiful. Ichimoku cloud, defined support, rising 30-week average, price action above. Here was your first warning sign. Look at that. huge red candle right here on the volume. And no more green, no more. This is actually a beautiful, beautiful stage 2 right here. You guys have held this for a few years, from 2016 all the way up here. Oh, barely closed below 30-week average. Consolidation continued. Always outperforming the SPX. So instead of holding the SPX, if you would have just had one position, you would have been, if you would have been this stock, you would have been outperforming the SPX. You would have got better returns until this crazy close right here, getting further and further away from the 30-week average, waking up those sellers. And then you're out. You don't go back in. Even here, this is, even if you go back up here, now I want to see if, because right here, oh, it's not super pretty. Huge green volume. This could have been a stage 2 continuation breakout, but you want it, I would have rathered it to be tested multiple times before breaking out right here. And I want to see if the monthly chart could have saved us from entering here. It's this candle right here. Some sellers coming in. It did close above. Let's go back here. So here you don't know. You're there. Oh, look at that candle, Pat. So this could have been an entry right here, but that wick should be a warning sign that you didn't close the month in strength. The sellers came in, brought it back down, getting away from the 12-month moving average. Those are some warning signs. It's not the healthy breakout that you see right here off of bottoming going up. You're actually trying to do a stage 2 continuation of volatile candles that actually pierce down below the 12-month average, not above. So you had some warning signs right there. Not to trust this could have been a final flame on moment where you just burn yourself out and get trapped. So why, when you're ready, you want to play these things, you should say, why should I play something that has for years going up, showing me signs of volatility, which are more danger signs than these small increments? We'll have a wick where the sellers came in, closed the month, barely close above, or not a convincing close above that breakout line, which hasn't been tested recently. When you could just be finding stocks that are entering this stage right here, just exploding right there. Like here again, get far away from 12-month average, and then you get those huge red candles, lots of damage. Sometimes you get back up like you did here, but sometimes you just suffer, and it takes months and months and years, and you don't want to hold all that time. Well, big warning signs, and listening to those warning signs could have saved you some hardship. Here you could have said, oh, to the moon. But that's just a few months, and after that you're back into the stage 3, and now getting closer to that breakdown line, closer and closer to a stage 4 on the monthly chart. Okay, let's go back. Weekly. So we see the monthly chart could have saved us here. Back within that stage 3, below Ichimoku cloud, trying to go back up. But what happens is now you're below the 30-week moving average. It's starting to decline. Trying to make another go at it. So showing some strength here. You even see it here, outperforming the Russell. But this is trying to last gasp of air. Can't quite make it. Sending in lower highs. And now we're back below a declining 30-week average, and we're starting to create some overhead resistance right here. So as we had symptoms of an uptrend here, we're starting to create symptoms of a downtrend below declining 30-week moving average, below a declining Ichimoku cloud. Final step, it'd be a declining 12-month moving average, and then you have the trend in your favor. So big top pattern. Wait for a close below that monthly defined breakdown line at 1758, and you could wait for an additional weekly close below 17 right here for the ultimate look out below situation. All right, that's it, guys. Vishay Intertechnology. going down. All right, guys. Ciao.